So glad to be with you guys today. I'm hoping this presentation weaves in with Natalie's Intro to Investing Part 1 and hopefully deepens some of your earlier learnings. So a little bit about me. I've been working in the banking industry, splitting my career right down the middle between banks and credit unions for a little over 10 years now. And I can guarantee that I've seen the good, the bad, and the downright ugly when it comes to personal finance. I deal with everything, banking, credit, and investing, but for today, let's focus on investing. So Danny, if you could hit the next slide for me. So there are 4 basic tenets that I highly recommend keeping in mind when you're investing. I promise if you stick to these 4 guidelines, you'll avoid many of the pitfalls that Canadians face over their financial lifetimes. So the very first recommendation I have is pay yourself first. It's a controversial place to start. It's so easy to say and so hard to do. You know the saying, put on your own oxygen mask first? Well, it applies to investing as well. So here's my ask. Pay into your savings accounts before paying your bills, before paying your housing expenses, your food, your transportation costs, and for your entertainment. Budget for the rest of your monthly expenses after you've set aside some savings first. I know it sounds like wild advice, but it will help keep you and your long-term goals safe and sound. It could be as little as $25 a paycheck, but starting the habit will absolutely serve you all life long. Some companies even offer pension plans, group RSPs, or other savings benefits that come out of your paycheck before the money's even deposited into your account. Please take advantage of these benefits. They add up quickly behind the scenes, and honestly, you'll be shocked by how much you can save after a year or two. And as a side note, this is actually the best financial advice my father has ever given me. Maximize any and all company financial benefits. They make up a part of your total compensation package, along with your salary and your healthcare insurance, so don't be shy. Grab as much as you can for yourself. Now, not all companies offer these types of benefits. In fact, it's getting more and more rare. If your work doesn't, you'll have to manage it yourself. So whenever your paycheck comes in, set aside the savings before a single penny comes out of your account for anything else. I know it's really hard to advocate for this when there's immediate financial matters that are glaring at you. I mean, I know from personal experience, it's easy to see a massive credit card bill and your rent looming and think, I could dig into this account or wipe this balance out with my savings. It's so tempting to tap into retirement savings or long-term savings accounts when emergencies pop up. As a side note, this is why I'll be recommending the bucket savings strategy, and we'll talk about that a little later. So to stay away from temptation, I sometimes recommend keeping your long-term investments with an entirely separate financial institution, so you're not seeing the money every day online or on your monthly bank statements. You can check on your savings periodically, but we all know a watched pot never boils. Sometimes it's best to just set it and forget it. So Danny, if you could hit the next slide for me. So piggybacking onto the concept of paying yourself first, investing often really helps strengthen the habit of building your wealth. So while you're putting a little money away from every paycheck, you're investing the money into something that will grow exponentially, as Natalie had reviewed in part 1. Danny, if you could switch slides for me. So there is a concept in investing called dollar cost averaging. And if you could switch slides one more time. So I pulled up this chart. It's a very busy chart, but I pulled it up to give you an idea of how dollar cost averaging works. So Danny, if you could run your mouse over sort of the squiggly lines, you see there's purple, blue, yellow, and red. Those lines, you can just focus on those. They represent different stock markets all over the world. So as you can see, there are tons of ups and downs, but generally speaking, there is an upward trajectory with all of those lines. So in actual fact, at the very bottom left-hand corner, this shows $100 invested 50 years ago. So that means if you take $100 in your pocket today and invest it now, in 50 years, at the very top right-hand corner of the chart, you could have earned up to $153,000. So the concept of dollar cost averaging comes in when you put in a little bit all along those lines. So when you invest a little bit bi-weekly, semi-monthly, or monthly, you're buying a little more product all along that line. Sometimes the market is down and you're buying a little more of that product, or sometimes the market is up and you're buying a little less of the product. But by purchasing a little along the line, you're avoiding putting in a large amount of money when, say, the market is high, and so you can average out your purchase price over the years that you're investing. So this chart shows what happens when you invest for 50 years, but not all of us have that much time to invest. Typically, most Canadians start investing around age 30 and stop contributing to their investments when they retire, usually around age 60 or age 65. But I'm telling you now, every extra year that you stay invested creates a huge change when you get closer to retirement. So if you could switch to the next slide. The three principles that we just talked about come together when we take a look at this particular calculator from the Ontario Securities Commission. So Danny, I'm going to get you to put you a little to work. If you could click on that and open it up. So this is a government website, so there's no company affiliation with it. It's created by the Government of Ontario, and it's a very simple way of showing you how little changes that you make can really impact your bottom line with long-term investments. So Danny, if you could put $100 in the initial investment space and start off with, let's say, a $25 a month regular addition. And then in the interest rate section, let's start with an average investment account interest rate of 5%. And let's say you scroll down a little bit, the interest is actually going to be compounded annually. And for our time horizon, time horizon's years, and in the interest rate is compounded. If you could hit, yearly, perfect. And then let's go, so we're at 30 years. So let's say you started from age 30 and you're investing till age 60. So when you hit calculate, over 30 years with this strategy, you're going to be earning $20,000 with more than half of that money just made from interest alone. So it's doing the hard work for you in the background. But Danny, if you could scroll back up and try $25 bi-weekly instead of monthly, you can see when you go to calculate again, it more than doubles your savings. If you go $50 bi-weekly, you more than quadruple your savings. If you add an extra 5 years of investing, you add an extra $40,000 to the pile. If you invest a little more aggressively, let's say earning 8%, you actually get to $233,000. And finally, Danny, don't worry about it. And just to let you know, I've run the numbers ahead of time. Finally, if you invest from age 25 to 65 instead of 30 to 60, you actually get to $350,000. And in that scenario, you've only put in $50,000. So $300,000 is just created by interest alone. And you've got $350,000, not a bad little nest egg for saving a little bit bi-weekly. So if we can go back to the PowerPoint, the very last cardinal rule that I like to share is diversifying. So with that nest egg that you have, speaking of those little nest eggs, You want to make sure that you're not putting all your eggs in one basket. You definitely want to diversify. So if you could go to the next slide, this chart here shows the investment winners and losers from each year. You don't need to look at the little individual boxes, but suffice to say, you can see there's no rhyme or reason to what type of investment performs the best each year. That's why I recommend investing a little bit in all of them. If one does badly, another will hopefully prop it up. Overall, this will make for a much smoother investment experience. Basically, we're trying to minimize the volatility of your investments for a more pleasant experience for you. So we've just gone through the 4 cardinal rules of investing. Now you're ready to invest. Where do you put your savings? So to add to Natalie's original presentation, I want to review the bucket savings strategy. Not my strategy, I stole it, but basically it recommends that you open different accounts for different purposes. So in your immediate needs, you've got daily and monthly transactions. You've got to buy your lunch and your rent and your bills and all that good stuff. So for that, we usually recommend a checking account. Pretty straightforward. Then you've got short-term savings with a goal to spend the money in, let's say, 1 to 2 years. So think emergency savings, vacation savings, maybe a larger purchase. For those goals, I would recommend a savings account or potentially a guaranteed investment certificate, also known as a GIC, also known as a term deposit. Those 2 products, the savings account and the GIC, protect your balance and guarantee that the money will be there when you need it. After short-term savings, you're looking at medium-term savings. That's with a goal to spend in 3 to 5 years. Think saving for a down payment for a home. Think maybe saving for tuition for certificates, diplomas, degrees, that sort of thing. Those would also be supported by your savings accounts and your GICs. Now, the really interesting, more long-term strategy, usually retirement savings, that's when your goal is to start spending money when you retire, usually around age 65, and you're going to be taking small monthly withdrawals to then pay for your month-to-month expenses. For these types of savings, I usually recommend people that are just starting to invest take a look at mutual funds. And the way I describe it is to think of traveling. If you need to get to your local grocery store, you might take a bike or you might walk. If you're traveling across town, you might take a bus or a car. And if you're headed to Vancouver, you might take a plane. So investing works similarly. We tailor the product to fit the expected lifetime that you're going to need the savings for. So as I said, immediate, short-term, medium savings can all be taken care of between checking accounts, savings accounts, and GICs. Let's focus on those long-term savings products. So mutual funds are what I recommend to new investors. It's a way to dip your toe in the investment waters, and here's why. The amount of money that you need to get into a mutual fund is usually around $500. There are some products in the investment market that needs upwards of $100,000 to buy into them. I can't even get into them, so we start small. You don't have to manage the mutual funds by yourself. There is a mutual fund manager that does all the work for you. So you set it and forget it, but maybe try to revisit it with annual checkups. The other thing that I like about mutual funds is they really meet our goal of diversification. So they can be invested in every industry all over the world. So you're really getting a slice of the entire global economy in one product. You could switch slides for me. So mutual funds were popularized in the 80s and 90s. Basically, mutual fund managers pool together a bunch of individual investments, usually stocks and bonds, into one bundled product. So you as an investor can buy a small piece of the product like you would a slice of the pie. So that way, everyone invested together shares in the profits and potential losses depending on the year. Mutual funds can also be bundled into mutual fund portfolios. They're also called funds of funds to keep it confusing for you. So that means there can be thousands of underlying individual stocks and bonds in these mutual fund portfolios, creating even more layers of diversification. You could head to the next slide for me. So there are thousands of mutual funds offered in the Canadian marketplace. They have a lingo all of their own. So I've created a basic cheat sheet to help sort of demystify the product titles. So for some reason, instead of using the word stocks and bonds, the mutual fund world likes to use income and equity. And they like to use the word dividend for stocks that are usually for big conservative companies in Canada. Often banks and insurance companies are called dividend stocks, also known as blue chip stocks. But that's a little bit of the basic lingo for understanding what's going into the particular mutual fund you're looking at. If we head to the cheat sheet part 2, the mutual fund portfolios that I were talking about, they're generally divided into essentially 5 different products. And they go from very conservatively invested to very aggressively invested. And each term has its own weighting of stocks and bonds. And so you can see the more aggressive it gets, the more stocks you have in the mutual fund. So we start from a very conservative product that's mostly bonds, that's to a very aggressive product that's usually 100% stocks. So you can, depending on what kind of appetite you have for risk, you can slot yourself in with one of these sort of 5 levels of mutual funds. And then if we head to the cheat sheet part 3, there are a couple of odd little words that get thrown in as well. So mutual funds, you know how we talked about the mutual fund managers? They can be looking at this mutual fund and making decisions on the investment strategies on a daily basis. Sometimes they're managed weekly, sometimes bi-weekly, sometimes quarterly. So the more often the fund manager is making decisions for the mutual fund, the more active the fund is managed. So a managed mutual fund means that the mutual fund manager is looking at the fund often. Whereas an index mutual fund usually means that there's nobody really looking at the investment strategy on a regular basis. It's usually done quarterly or maybe even annually. And those types of mutual funds are considered passive because they're just not researched and modified as often as an active management mutual fund. So essentially, the more a mutual fund is managed, the more the mutual fund manager is going to want to get paid for his services. So a managed mutual fund usually ends up being a little bit more expensive, and an index or passive mutual fund usually ends up being a little bit cheaper, but you're not getting the benefit of the daily or weekly, excuse me. So as I was saying, you're not getting the benefit of the daily or weekly management of that particular mutual fund manager. So the last piece of the puzzle is there are some mutual funds that will go from very aggressively managed to very conservatively managed over a particular time frame. So those are called target date mutual funds. So essentially you literally have to do nothing. As the fund gets older and older, it will become more and more conservative. So the fluctuations year over year will become smaller and smaller and smaller. Typically what we do is we arrange for your mutual fund to be at its most conservative point when you get to retirement, so that the money is there for you, it's not fluctuating as much, and you're a little bit more secure with the balance that you have while you're getting to retirement. So if we could switch to the next slide. So every single mutual fund offered in Canada has its own brochure, and it's called a fund fact sheet. And so I've pulled this link up from the Canadian Securities Administrators to walk you through what a sample brochure will look like for every single mutual fund product in Canada. So thank you for opening up the hyperlink, Danny. So there's always the fund title at the top. And if you can zoom in just a little bit, in the quick facts section, you'll see that the mutual fund, this particular mutual fund, this fake mutual fund, was created in March of 2000. So I always look at the date that the mutual fund was created because I want to know, does it have a track record? Is it brand new? Is it untested? Is there data that I can look at to see how it could potentially perform in the future? The other thing I like to look at is, so you see the minimum investment in the bottom right-hand corner of that box. So as I said, most mutual funds, you need $500 to get the ball rolling. And then sometimes minimum additional deposits of usually $25, sometimes $50. So in the middle of the screen, you can see the top 10 investment holdings. So this sample one is mostly invested in financial institutions, as you can see. But so every single mutual fund will always show what their top 10 individual investments they're invested in are in that list. And on the right-hand side of the page, it shows you which industries it invests in. So you can see the majority of it is in banks and insurance companies and energy. So probably oil and gas. It seems like a very Canadian mutual fund. But it looks like there is a little bit in every industry. So again, you're getting that diversity that we talked about. So if you scroll down a little bit further, we've got the actual risk rating. So every single mutual fund in Canada is rated by a separate institution. This example shows a medium risk rating. So in the grand spectrum of all mutual funds, it's kind of right smack dab in the middle in terms of how risky and how volatile it is. And if we scroll down a little bit further, this mutual fund is a little older, so you can see the history of its performance in that chart there. So as with every mutual fund in Canada, there's some down years and there's some up years. But statistically speaking, the longer you hold this mutual fund, the more likely you're going to have a positive average return. So in this example, you can see in the little box below, the very worst 3 months, this particular mutual fund lost about 25% of its holdings. So that means if you held $100, you'd be down to 75. But the best 3 months earned about 32%. So if you had $100, you'd be at $132. And in fact, I don't know why they bury it, but there's always this average return section that shows that if you held the mutual fund for over 10 years and you started with $1,000, it always tells you what your balance would be up to the current date. So it's a buried little line, but it's so important to understand what your average return will be. So in this case, 6.8%, which is a pretty reasonable return for a mutual fund like this. So always look at that little average return section. It's sometimes hidden, but it's so, so important. And then at the very bottom, as I said, the mutual fund managers don't do this out of the goodness of their hearts. They definitely charge you for this product. So in the how much does it cost section, if you scroll to the bottom a little further, the most important thing I want you to look at is here, the fund expenses line. It's bolded so you can see the total fund expense is 2.3%. And what this means is for every dollar that you put in, this mutual fund company is going to take 2.3% of what you've invested each year from the account. So that's their fee for doing all the research, making all the investment decisions, and making decisions in terms of where the mutual fund is going to go in the future. So for all of those services, they're going to charge you 2.3%. And as I said, the more actively managed, the more often the mutual fund is managed, this fund expense is higher. And the more passive, or the less often that the mutual fund manager reviews the product, that fund expense will be a little cheaper. Also, the more stocks you have in a mutual fund, typically the more expensive it is. And the more bonds you have, typically the cheaper the mutual fund is. So that's really what you really want to focus on when you're looking at a mutual fund brochure. They all have this information. It's mandated by the government, so you can compare apples to apples and make sure you're really picking a product that makes sense for you. But if you ever have questions about a particular fund fact sheet, I am more than happy to review a product with you. It's always a good idea to get a second opinion, a third opinion, just to make sure that the product is right for you, okay? So if we could switch slides back to the PowerPoint. Beside the mutual fund, there is a newer product called an exchange traded funds, also known as an ETF. So exchange traded funds are very similar to mutual funds. They're created by a fund manager, but once the product is created, it's not actively managed. It's literally created and then let run its course. So for this reason, exchange traded funds tend to have a much cheaper annual fee because they just charge for the initial creation of the product. So it's very similar to a passively managed mutual fund, except it's not really even managed intermittently. It's a set it and forget it product. So some people believe it's better to have a cheaper fee and just ride out whatever happens once the product's set out. Some people believe it's better to pay a team to manage the product and smooth out the rough performance edges. In the end, it all depends on your individual comfort level with volatility and with that fluctuating curve to make that decision for yourself. So I think we maybe had a question in the chat section. I just want to make sure I get to it before I change topics.
Okay, you could hold the questions to the end since you're close. You could wrap up and then we can take all the questions.
Yes. So the last thing I'd like to take a few minutes to discuss is what's on everybody's mind. If you could hit to the next slide for me. The beautiful world of cryptocurrency. So I'll start off by saying that financial fads are really nothing new. There was even a tulip craze in the Netherlands in the 1600s. Some tulip bulbs became worth the entire cost of a mansion in the Netherlands. There was a dot-com bubble in the 90s where some investors were speculating on internet-related companies. In the end, there's two factors that motivate investing: fear and greed. And the true goal in all investing is to buy low and sell high, but it's definitely easier said than done. So cryptocurrency was also originally touted as a fad, but many are now predicting it's here to stay. Either way, everybody's talking about it. Keep in mind, news outlets receive funding based on the number of eyeballs that are watching the screen. So for that reason, the drama needs to be created to keep advertisers happy. So by the time an investment product is being reported on the news, you're probably a little too late to jump on the bandwagon. You'll be buying high instead of investing often, and you won't be diversifying if you just put all your eggs into the cryptocurrency basket. And that breaks our two cardinal rules of investing. So there's a lot of noise out there about cryptocurrency. Hopefully I can cut through the volume to give you some key takeaways. So the first thing I will say is that cryptocurrency can be extremely volatile, meaning very high highs and very low lows. So for that reason, I would only recommend a small percentage of your portfolio, and by that I mean like less than 3% of your total portfolio, be dedicated to this type of product. And I think you may have heard that it's not a regulated product. It's not regulated by a central bank or a central government. So that means there's no one to call if you lose your access to your information or you process an incorrect transaction. There's no 1-800 number to get the money back or to correct it. The lack of regulation, not quite. The lack of regulation also makes cryptocurrency a hugely attractive venue for money laundering and also for terrorist financing. I don't love that feature personally, as I've spent pretty much my whole career trying to keep my customers' money safe. And these currencies definitely help facilitate illegal activity. But on the other hand, one thing I also want to advise is that the computing energy needed to host this type of technology is absolutely astronomical. There is an environmental component to this that we probably shouldn't ignore. I personally don't own any crypto. That's not to say my position won't change. I just want to make sure Canadians aren't, again, putting all their eggs in one basket. And all that being said, all those warnings being said, there are benefits to purchasing some cryptocurrency. So the crypto market doesn't seem to be following the stock market, the bond market, the real estate market. So you are introducing a little bit of diversity by putting some of your savings into this brand new market. I also will say the way the blockchain technology that powers cryptocurrency has been created, it makes the product particularly robust in terms of security, which I do appreciate. Also, because of the fact that it's not regulated by a central bank or central government, the records that are held by thousands of different developers in the market. So they tend to be very accurate and always up to date. I would highly recommend talking to an advisor or someone you trust before getting into this market. Definitely do your research and remember this guideline. If you can't explain it to someone else, you probably shouldn't be buying it. So now that's sort of my little spiel about crypto. I think I do see some questions about crypto. Let me just take a look at that chat section. Okay, so, oh, okay, sorry, for mutual funds. Yes, so mutual funds can be purchased and sold at any time. However, most mutual funds have a 90-day hold period. So they'll charge you a fee if you sell it, if you buy it and then sell it within 90 days. So you really, I mean, after that 90-day period, you're free and clear. You can do whatever you want with the product. But just be careful with that short-term turnaround of mutual funds. They're not meant to be bought and sold like stocks. They're meant to be purchased and then held for long-term savings. And the other question, how do you know which crypto to go for? There seem to be so many of them. So again, that is part of the problem with cryptocurrency. The two most popular seem to be Bitcoin and Ethereum, but there are now thousands of them flooding the market. It seems like anybody's creating their own currency at any moment now. So that is a great question. Nobody really knows the answer yet as to which currency is going to win out. We're thinking probably Bitcoin, but it's still early days, so it's still hard to say who will be the winner and who will be the loser. Again, that's why I just recommend not investing too much of your own personal savings in a cryptocurrency, just because of the uncertainty.